Oh, okay. Okay. Good. So in the remaining time until 12:30, we will tackle the topic of valuation and grant considerations. Also, again, a bit founder perspective. Please ask questions, and we then make a break until 13:55, because at 2 o'clock we will have the privilege of having Kathy Wilhelm from Index Ventures. So I really want us to be on point, because she's joining in from Lisbon, I think. But that just as a note. Okay. Yeah, we will talk. We will talk about Index Ventures once they're here, but it's just as also a very, very big fund in Europe, and quite impactful. So it's good to know and have this connection for whatever you want to do next. So I brought with you a recent Financial Times article with one of the co-founders of OpenAI, Ilya Sutskever, who went out of OpenAI. I'm not sure whether everyone knows the story, but otherwise it's a great crime or binge watching episode on social and other places to learn about Ilya's role in like firing the CEO and then having the CEO back, and now then he left OpenAI, but that's for another story. But he left OpenAI. He then went silent and came back with, of course, some really great investors on the side, with his seed, or I don't even know, pre-seed valuation of 5 billion, raising 1 billion. So that is sometimes what you see and then think, okay, what did we do wrong? Because, for example, in our case, when we raised the seed round, it was 1.2 million. So just to show you a bit, this is one side of the story, and it's most often the super extreme cases, but this is not normally, if you're not a subscriber or a super hyped AI startup, it's normally not in this area, but of course this happens. And then there are other valuations, and I here brought you, and we will dive a little bit deeper into it afterwards, but I brought you a nice LinkedIn post that who is also a serial entrepreneur, posted, I think 3 months ago, and he made the point of, I invested in a few funds, and there was an email from one of the investors, and it said we only get 20 cents out of $1 in an investment they made a few years ago. And apparently the company got acquired, but at a much lower valuation than the initial investment. And a few weeks after that email, he saw an article celebrating the exit, and then the same investor posted on LinkedIn to congratulate the founder and the team on the achievement. And the founder even changed his tagline to "Exit SaaS Founder," and that then triggers the PM to email back the investor with 2 questions, because he believed that there was a potential typo on his first email. And the question was, did the founder actually get any money on that deal, and are we as investors making any money off that deal? And the investor's answer was twice no. And he then makes the fun joke like, cheers to another successful VC-backed exit founder. Now, why am I bringing that to you? I found that, especially in the past few years, there was so much buzz online and so much about like, yes, unicorn, yes, whatever valuation, and so on. The bigger the better. And as you will see in the next few hours today, just because you have a high valuation, or just because you after high valuation exit, doesn't mean at all that you see any money on your bank account. And this is just to illustrate that in one way. But this is what we are going a little bit deeper into that. I also brought you, but this is more if you have a bit more time, some stats on media seed valuation. So remember, Ilya Sutskever raised 5 billion. Normally, it's more around the 2 to 3 million over time. but that's just as a comparison. Disclaimer: these are numbers of U.S. Companies, but it's like similarly, maybe a bit lower, but
I think in Switzerland at the moment, like a pre-seed angel round would be around starting at 300,000 and can go up to 1.5 million. And this is non-biotech. For those of you that are interested in biotech rounds are by much more higher. So they were raised about 10 to 15 at the moment, but everything dropped down a bit in their first round.
Yeah, and another important point here is that we now talk about, like you just said, pre-seed. In the previous picture, it was about like seed. And what now has also happened, just that you're aware of it, what was called maybe only 5 years ago a seed, or even Series A, is sometimes now called seed. So the numbers, you need to take that with a grain of salt, exactly, because like it's again also a story that you tell, and it's much nicer or crazier if you can talk about, yes, I raised 10 million for my seed round, but actually in the old days it would be a Series A. So this is why I brought you the asset cover case. Like there is so much buzz around it, and then you also need to look into the details. Yeah.
Sorry, I don't know that much about startup theory, but usually when I hear about investing stuff, for me it's a little bit, how do you say, there are a lot of fancy words here and stuff.
Oh yeah.
So have these abstractions of a seed, Series A, Series B, Series C helped in any way? Or is it more of a, let's speak fancy, let's say the good words?
Yeah. I mean, of course, like the whole VC game, it is also a sales. This is not even for me. It was Andreas telling it. I was so happy that it said that, because I also see that it's in the end, it's an enterprise sales pitch that you do, and the better you sell, the better your terms are, and so on. We will dive a little bit deeper into that. Now to your question, how did it help? If you're now looking for funding, it's very important that you understand that there are funds that invest early, and then there are funds who invest only if you're at Series D. And I was at the presentation of another Swiss early stage fund a few days ago, and they showed actually the huge funnel. So they get, I think, for one of their funds, they got 30,000 like applications from all sorts of from all over the world, and in the end, I think it was 15 or 20 cases that they invested in. And I was like, what is happening? Like 30,000 applications, how is that possible? And there she said, hey, there were so many not realizing that we were an early stage fund, not realizing that we have a focus on B2B and some other industry, but maybe not biotech and health. And so for these kind of outreaches as an investor, as a founder, to reach out to investors that you want to invest, it's super crucial that you understand like whether a fund is early stage or late stage. Now, to make it a little bit more complicated, if you're a first-time fund, and I'm happy that tomorrow there's Andrea talking a little bit about it. But normally, if this is the first time that you actually open a fund, you focus on one area, let's say on early stage. And only after you prove that you are actually a good investor and return the money, you then often open or I don't know the proper word, but open a new fund that you then maybe have for growth stage, because you ideally want to if you think about the power law game and the fact that 9 out of 10 if startups fail, you want to make sure that if you invest in, let's say, Facebook, that once Facebook went through a couple of rounds, that if you see that this is going to be a $1 trillion company, that you then can follow on the later rounds as well, because you bet on that, and that will then also save your returns for your LPs. So this is why some funds, and Tomiko that we had this morning is such a fund. They have an early stage fund, but then they have also a growth fund. And normally, like the great cases that work well, that were invested by the early stage fund, will then be followed on by a growth fund.
And maybe our colleagues talked about this, but you know, when you have funds, you're never going to deploy money with the same strategy from two open funds. So read the website. If they say they normally disclose how many open funds they have or how their investing strategy is. So there's some like index that we're going to hear later, and Atomico have several funds that they're deploying money from, but they raise the capital from LPs with one hypothesis per fund. And if the hypothesis stays the same, like Founderful, then they invest out of the one fund and then they will move to the next fund. And the important thing is to understand also as a founder, people then will tell you, oh yeah, we can invest in you. And then you wait. And sometimes can be that they can't invest at the moment because their old fund is just closing out. And in an old fund, they need more riper startups, so more later stage startups. Why? Because the fund has to return within 10 years. Did you talk about that those other 2 days? Yeah, okay, good. Just to re-marinate that idea of that funds can move from seed into Series A if they're older with the same fund. And just read the website. If you're fundraising and you're not sure if they can invest in you, read the website. Normally they should be disclosing that pretty clearly.
Yeah, and another other thing that I was not aware of is that yes, you have on partner levels, you have like they're all equal. But what I've heard many times is that, let's say you reach out to one partner, and this is maybe not what is her focus. The likelihood that she will pass that on to another partner in her fund is very low. So make sure as a founder that you do your research and you look up like, okay, Andreas is like investing in B2B SaaS. So if I have a B2B SaaS, I reach out to him. But if I have a health tech startup, then I'd rather like reach out to his colleague, because they are in the end, they also winners for their own kind of merit. And so this is why it's super important that you do your research before you reach out. And this also explains why you have VCs that get 13,000 applications and then only invest in 30, because there is so much noise and people who are just like spraying and praying, and this is not really what is working out. Good. Now, when we take the angle of what do we actually, especially as a founder, what do we optimize for? It's mainly 3 things. It's kind of the amount that I want to raise, and there I think you had it in the first two days. Does anyone remember why you should why a round should give you around 14 to 18 month runway? Do you remember?
I'm gonna shout it out.
No? Yes?
I would suggest you need to, I would say almost about a year for the next funding round.
Yeah.
Have some time to actually work on your company, and then also time to actually fund the next round.
This is exactly the case. So you normally say you should at least be able to show 1 year of progress, and then you need around half a year to actually raise the round. And so this is why in the best case you have 18 months. Sometimes you even say like every 24 months. So that really depends. It also depends the market environment. As I said earlier, we come from a period where it was super easy to raise funds. Now it's a different story. So this is why make sure, because if I know one thing, fundraising is so stressful, and especially as a CEO, you're completely absorbed. So you cannot really focus on the daily business. You have to go to all of this VCs, have the due diligence. I mean, you saw like the meetings that they have, and normally you don't just speak to one VC, but you speak to many VCs, and it's just like it completely absorbs you from the daily business. And so this is why you want to make sure that on the one hand you have enough runway to not do that every other month, but then at the same time that you also can show something that you then also get the amount that you need.
And the other thing is also from the investor's perspective, right? You don't want to give money like a drop on a hot stone, just doing an English quote that's good in German. So you will also cross-check, is the company raising sufficient amounts, and do they have also sufficiently enough people that said yes to get them those 2 years? Because if you invest only what your fund can do on a CLA contract, and then they run out of cash in the meantime, you should have known that. Like for us as VCs, it's a bad case if your startup has to close within the first half year to a year, because that is something you should have seen in the due diligence and supported them with. So also we would check as VCs, can they raise the sufficient amount to carry themselves for 2 years to 2.5 years?
Can you maybe, I'm not sure whether everyone is aware of what the difference is between CLA and equity, a price equity round?
Okay, a CLA is basically a contract. In the US, we call it a note. So you're able to get, so let's say I'm a VC, I sign it and I wire them money within 2 weeks. So you can consistently raise on these terms. With a shareholders agreement, it's a price round, so you know how much you're going to get. So we get like the amount is going to be set. We're going to talk a bit about valuation, but this set price for the shares I'm going to get. With CLA, it's a convertible loan, so I give them a loan, and then the next price round, I get the shares as an investor. The problem with the CLA out of investors' perspective is we don't know how many shares we're going to get, but we also do not want to move our money in if they're not raising a sufficient amount on the CLA over like 2 years, right? CLAs are also handy for bridge rounds. So this happens often that startups runway runs out and they haven't raised the next round and you have to bridge them. So then you bridge them with a CLA contract. CLA is a Swiss, German, and I would say in Europe, you know CLAs, the Americans would call it notes. If you want to read through these contracts, we have links, right? The notes contract is very famously on Y Combinator. The CLA contract, I think both of these links are in our slides, just that you understand the mechanics. There was a question in the back. I don't know who. There was a question back there.
Yeah, that was me, but I was asking about the burning rate, if it has something to do with the 14 to 18 months, like when you raise money, that you calculate the burning rate, it would be also.
Yeah, I mean, basically, so the question for those who are online, like whether the runway has something to do with the burn rate. Yes, because the burn rate is basically what you burn per month, and then you just calculate like how much. Also with your HR plans, like how many people do you want to hire in this amount, like how much does that cost, and then this is how you get the runway, how long this money that you have in the bank, and then hopefully also ARR from your customers will help you until when you would run out of money, and in the best case, yeah, you have
You
it.
do this after you get the money or before to get more money, or when do you calculate it?
As a VC, we always will check the burn rate, and we also in the quarterly reports, when we ask for quarterly reports once we're invested, they send us the burn rate, they send us the information on cash in the bank, because let's put it this way, if you're burning too much cash and your funds are running out within a half a year, we have to think of destaffing and letting people go because they're in 3 months contracts in Switzerland. In the US, you can let people go faster, but this is a hard reality sometimes with entrepreneurs and as investors, we also have to help them manage it. Because if you're not able to pay salaries and if you're not able to pay social insurances and taxes in Switzerland as a business owner and also as a board member, they have a so-called Durchgriffsrecht. That means they can go through your company entity onto your private assets. So these are really the things that just for fairness, you have to be very aware of. So burn rates are consistently calculated. They're in your normal budgeting forecasts, and they're going to be also asked for as a VC. We ask for this information.
And for anyone wondering, why would I, as an investor, do a CLA? If because the thing between equity rounds and CLA is basically with equity rounds, you have all the due diligence and like it's a very complex process where you really look at all the numbers and stuff like that. Normally in CLA, it's not so complex. Yeah, as you said, you basically, I mean, over a chat, etc. But you buy the money and then look later down the road, like when you raise an equity round. And the thing is that you normally give a discount to the investor that gives you the money in a CLA. So we talk here about like 20%. So you basically get more shares than you actually give the money to. And this is then the incentive why anyone would be crazy enough to give you money without doing the proper thing. But most often, or not most often, but I've seen it often that it's basically current investors or even angels that will give you more money because they have an understanding of why you need this money to reach the next milestone, and they are also the ones that should, in the best case, believe in you, and so they wire you more money because they have a basic understanding that where the money is going. So yeah.
And CLAs are only used very, very early stage. So these typical angel rounds. So if you see Thomas tomorrow, Thomas Stubendorfer, he will sign probably asking the question, I would say sign 50% CLAs, 50% shareholder agreements. Later stage funds like Atomico, they will not sign CLA. Okay, this is really just a pre-seed seed fund instrument.
Yes, so we have the amount, and then we also have the valuation, and we will have a short exercise, but you will have the link, and then you can play on your own, where we see a little bit what this means with which valuation and dilution. Normally, we speak of, I mean, the number differs depending on who you ask, but normally it's between 15 and 25%. Which every round that you make, you give away 15 to 25%. You will see that afterwards in a doc. It has a lot to do with negotiation, but we will shortly talk about that. And then it's also something that is very important to triangulate that in your thinking when it comes about raising money is to what do you think is possible in terms of value creation. Normally, there is this number of 3 to 5x valuation next time, meaning if now you raise money with a valuation of, let's say, 2 million, the expectation is that in at least 24 months when you're raising the next, or in 18 months when you're raising the next round, it should be at least 3 to 5 times as much. And so this is why you can already see, if you think, wow, we're amazing, we have a 500 million valuation in our pre-seed, well, good luck in tripling that within the next 1.5 years. So this is why it might be tempting to always go for the investor that gives the biggest valuation. But there's this lame saying like after the round is before the round, and you just need to keep that in mind. So it makes sense that sometimes you go with a lower valuation because it kind of takes away a little bit the pressure.
And another thing I like to cross-check, that everybody works different. You know, let's say we're investing in a startup, and I think about, well, who would buy them and how many years to which evaluation? And then you can slice and dice the rounds that are coming up and kind of estimate what are realistic evaluations and which framework should we be kind of settling at the moment and what is totally out of scope to reach. And often you have to explain this again to founders and support them to understand it, because sometimes they think it's just a negotiation where they're trying to get the best option today, but you have to think about what Melanie said for the future, that it kind of works out. So we don't have that comment that this LP gave, right, that he got 20% on the investment. That is not an ideal case that we're trying to work towards. And where do I do this? Crunchbase or PitchBook, right? You can see startups and how they're evaluated. And normally if I meet a startup, I do something pretty simple. I think about who's their competitors. You see it in the pitch deck. And then I think about, is there an exited competitor? And then I Google how much they were bought for, or I try to figure out and approximate how much they were bought for. If it's not disclosed, the buying company sometimes is stock listed, so you can find it in their balance sheets, in their M&A activity. So there's like ways to kind of get in there, and also people in PE and in the M&A departments of big corporates, we talk together. So they sometimes also can disclose how much these companies were bought for. So this is all part of our due diligence process in the back.
So PE, M&A.
PE is our private equity companies. This means companies that buy companies, restructure them, and then sell them for more. And M&A, or merger and acquisition departments, that can be within corporates that are buying other companies. So most big companies have merger and acquisitions going on, and they have specialized departments that are dealing with this. And Migros is selling a lot of companies at the moment. I've never seen such a long deal list in Switzerland for a long time.
Yes,
Okay.
so in the last 9
Oh, I
minutes.
have a question.
Oh,
Very quick one.
okay.
Okay, you can also stand up.
Yeah, so just because you mentioned, I'm not sure if everyone knows what went down with the Best Smile deal, but maybe for me, I personally don't understand how Migros, or based on what they would make or like buy such a company, only then to realize, okay, it's not working out at all, and now we have to sell it at a massive discount. So how is it still possible? I mean, is it fraud on one hand from maybe a potential startup where you just present wrong numbers?
I think it's like hard for us to answer the question because nobody was inside the deal. I think times changed, so one was more innovation and acquisition friendly a few years ago. So when the decision was made to buy Best Smile, it's always a bet, right? Migros also bought Galaxus, that worked out well for them. So I think in a total balance, it's you always have to talk to these people and look at the times when these decisions were made. So I don't think Best Smile today would have happened, but it happened back there, and also was a different CEO. So you can also look at the leadership. The previous CEO was very innovation friendly, and now times have changed a bit. I'm giving you a diplomatic answer here.
Maybe I quickly also add something there. So if you have very big publicly listed companies, they often have a very big push from the shareholders, like you should grow, you should innovate, but they have already saturated the market. Migros and other companies have already gotten the whole Swiss or their food market. And so then they are pushed into innovating in tangential markets, but sometimes that's a bad idea. And then they end up not realizing that it's not their business, and then they have to push this off. So internally they structure usually also these, let's say, different business activities into different structures, also like Microsoft bought Skype, Motorola, all these things, successes, failures, and then they can also merger and acquisition them to other companies that are maybe a better fit.
Yes, so in the last 7 minutes, like I just wanted to quickly show you this really nice template, and you can see here below, and it doesn't matter if you don't see everything in very accurately, but here I can make it a bit bigger. Yes, exactly. So it's a template that you can play around, because sometimes with this whole evaluation game and how much shares do which people have, and what does this mean if I now have an initial round of X amount or a seed round and so on, it's sometimes quite confusing. And what I've heard like from others is that it really makes a lot of difference if you just have some basic understanding of how the numbers actually change over time. And this is a template that is accessible. So whenever you come into the situation, be it as a VC or be it as a founder, just play around with the numbers to actually get an understanding of what it means if you give this amount of shares away. And what this means, especially with the thought in mind that normally it takes like up until Series C, D, and it takes a few years, what this means then at the end of it. Of course, we all hope to be like this $1 trillion company. So if you still have 1.0%, it's still a lot. But of course, if you exit for, let's say, 500,000, then yeah, we also know that this is basically maybe not what you wish for. So this is just to show a little bit how this works. So we have here like the example of 3 founders. As you can see in this example, we now have somebody who has a slightly different share percentage. So 40%, let's say this is a researcher, and her research was what is really the core of it and what she has worked on in the past 10 years. We have discussed different equities, so that is just a case. And as you can see, like 100% is actually allocated to the founders. And now let's say you go into like an angel round, and there's an angel that gives you a ticket of 300,000, and an angel, another angel gives you around 200,000, and then you can see together you raise 500,000. You agree on a pre-money valuation of 2 million. I will quickly afterwards come to what is the difference between pre-money valuation and post-money valuation, because it's quite important to understand the difference. And which gives then a dilution of the round of 20%. You remember we said it's normally between 15 and 25%, so that's quite common. And then in the end, like the founders still have 80% and the angels have 20%. We then go on, we will raise a few months, actually 2 years in this example later, we raise a seed round, and at this time we have the VC fund, which is the lead investors. And normally, for example, also in our case, whenever we say we raised 80 million from Sequoia, the fact is Sequoia, like in this 80 million, like bears the majority of the amount. But we had then Speed Invest chiming in, Left Lane giving more, like we had lots of, even an angel investor who chimed in. So that normally have one lead investor, that's also the person or the partner who then, with whom you have negotiation, and with whom you also set the term sheet and all the details, and the rest is then just like jumping on the bandwagon. So in this case, it would be this VC1 investor with 1.5 million, and you have the second VC that is then chiming in. And as you can see, as this fund team did a great job, they are now at a pre-money valuation of 8 million and have then with this 2.2 million a valuation of 10.2, post-money valuation after that. Just a quick outlook, because we will talk about ESOP in the afternoon. Normally, at a certain point of time, you also want to incentivize employees. Basically, you want to incentivize them from the beginning, because if you want to have great engineers, let's say, or other great salespeople or marketing or whatever you need, you normally don't have the salary to give them, which they would get at Google's and the likes. And so you normally give them shares, and ESOP is kind of a program, an employee stock option program that you can give. And normally, especially I would say in the seed round, I'm not sure what you're seeing, it's if you don't already have an ESOP pool of normally 10%, the founders that come, the VCs that come in, they will kind of tell you, hey, you need to also have that in place. But we will talk about that in the afternoon.
You just, for those of you that are going to found companies, just do it at foundation reserve 10%, and we'll look at it in the afternoon.
Mm-hmm. Yeah. So as said, like you can play around, and it's a very good exercise, I find. Now, just I was mentioning like there's a pre-money and post-money valuation, and in the end, it doesn't really matter in brackets what you take. To be fair, like if you decide something that might sound more founder friendly, then the investor is intelligent enough to then just like change a little bit the valuation, and then you will get the same. But just that you have a proper understanding. If with this example that we had before, if the company is raising 500K at 2 million pre-money valuation, you see here the nice calculations that you have. So in this case, you take like the 500,000 divided by 2 million, and that means that the investor actually gets 25%. Whereas if you say we raise 500K at a 2 million post-money valuation, you then see that the investor actually has 20% in this specific scenario. So what I want to say here is just like make sure that, and normally you have that in the term sheet, but just make sure that you talk about the same thing. Because if one is talking about pre-money valuation and the other one is talking about post-money valuation, the latest in the term sheet, you will realize, well, we didn't talk about the same things. But that is just once you figured out what is what, then it's fine. But just this is why the calculation is helpful.
Normally, everybody's talking about pre-money valuation. I personally have seldom see a misunderstanding here, but I again emphasize if you're going to go into early stage investing, founders do not know this, right? And so you just maybe want to clarify it at one point before, and you can see it the latest when you're signing contract.
Yeah, exactly. And now, just last two slides. You might have the question, how are valuations actually defined? And I think Andreas already mentioned it, but it's basically random, to say very straightforward. There are a few methods. So I can warmly recommend you the Swiss Angel Investor Handbook from Thomas Windhofer, who will talk tomorrow. There he nicely showed like the different methods that theoretically you could actually use, especially in later rounds where you have more data. It might even make sense to talk about the VC, to talk about market comparables, what you were mentioning, or the Berkus method or discount cash flow. But at this stage, very early on, it's almost impossible. And so this is where it always depends a lot on team, on product, on market, on FOMO, and your negotiation skills. And I cannot overstate you. I have seen a lot of stories. Talking about FOMO, for example, a founder friend of mine had a lot of VCs lined up shortly before Christmas last year. And somehow then everyone vanished into Christmas. It looked as if he had a deal from several VCs, and then suddenly no one was there anymore. And when he followed up in January, they were all like, oh yeah, let's catch up later on. So basically, they were all on the deal because if there's one thing that VCs don't want to miss, it's an opportunity. And we'll talk about that in the afternoon. And so it's always the hardest to get the first VC into the door, but once you have one, you can go around and also play with that and say like, hey, I got the term sheet, blah, blah, blah. And so this is why one of your main tasks as the one who's leading the whole fundraising is making sure that all of these discussions with the VCs actually happen around the same time, so that you can play them out individually and get better terms.
Yeah, also the US investors just invest faster, and sometimes don't underestimate that you also should talk overseas with investors, because that then creates a lot of FOMO with the European ones.
Mm-hmm.
Just when we're going through it, like how do we think, I'm just going to highlight it. Normally a startup shouldn't give up more than 30%, right, of their company. So that sets the evaluation depending on their ask and how much money they're asking for immediately, right? So let's say startup asks me for 500,000. I do not, as an investor, want them to give up more than 30% because it's just unwise. So it automatically sets their evaluation pre-money at 1.5 million. Okay. And there's evaluation brackets that you can play with. Ask your colleagues what is at the moment sensible before you approach a VC, because then it doesn't sound like you're having a ludicrous ask, but you're somewhere in a range that could be plausible. So that's what I mean about the Berkus method. And then the other thing, the VC method of thinking through how much can I actually sell this company for and what is sensible in this round, is something that that I often have to explain to startups, like, okay, this sounds like a sensible amount, but this is just an unsensible amount. Exactly. And then as a VC, you want ownership stake. Okay, so you also have to control for until which evaluation do we go in and when is there a hard cutoff. And a lot of VCs have hard cutoff valuations where they will not invest.
Yeah, and closing this session is whatever you valuation get, always remember the fact that after the raise is before the raise, and you need to get like 3 to 5x valuation next time in 18 to 24 months. And so this is why make wise choices, be it on the VC side or on the founder side, because it will hit you the latest, the next round. So that was like the part of valuation and consideration. And let's be back in the best case 5 minutes, but the latest on 59, because we have this really nice lady, Katerina Wilhelm from Index Ventures, which will share a lot of her insights. She's a really, really cool person, so don't miss out on that. And now have a great
Also, alumna from Hansfield. We
Yes.
studied together and a partner at a really, really big fund. If you don't know Index, you can pull that up over lunch. Okay.